Welcome back to the channel where we break down what's really happening in crypto and the global economy. No hype, no noise, just the truth behind the moves that shape the future of money. Because while most people focus on prices, here we focus on power, the policies, institutions, and quiet decisions that decide where the entire market goes next. And today, that power sits squarely inside one document, the UK's new stablecoin rulebook. After months of speculation, the Bank of England and the Treasury have finally released their long-awaited consultation, the first full framework that tells us exactly how digital pounds issued by private companies will be regulated, supervised and controlled. It's being described as a world first, but once you read the fine print, it's clear this isn't about safety, it's about who controls the future of digital money. So let's break down what was actually announced, what it means for crypto, and why this could be the most important financial story of the year. For months, everyone in crypto has been waiting for this paper, and now it's here. The UK has officially released its consultation on systematic stablecoins, the rulebook that decides how digital pounds issued by private companies will fit inside the financial system. It's a big step, the first major Western framework that treats stablecoins. So what does the rulebook say? Let's strip it down to the essentials. Holding limits. Each individual will be capped at £20,000 in sterling denominated stablecoins issued under this regime. Businesses can hold up to £10 million. These caps, the Bank of England says, are temporary and could be reviewed later, but for now they exist to stop a run on bank deposits if people rush to swap cash for stablecoins. Every pound-linked token must be backed one for one with high-quality liquid assets. That means cash or short-term UK government securities. No commercial paper, no risky lending. In effect, these issuers must act like narrow banks. Users must be able to redeem their tokens at par value, one for one, every business day. That single line makes it clear. No more algorithmic stablecoins pretending to be backed by faith. Only verifiable reserves count. The Financial Conduct Authority will supervise smaller, non-systematic issuers and wallets. The Bank of England will directly oversee any stablecoin that could pose systematic risk. Think payment networks or issuers with millions of users. Every issuer must publish regular independent audits and demonstrate that their technology can withstand failures and cyber attacks. In short, no fly-by-night projects. Those are the bones of the framework, but the real story lives in what those rules mean. First, it legitimizes stablecoins. For the first time, a G7 nation is saying, these instruments are part of our money system, and here's how they can exist safely. That's a huge signal for institutional adoption. Second, it raises the bar. Small issuers and experimental projects simply can't meet these standards. The cost of compliance will push consolidation. Fewer coins, larger issuers, heavier oversight. Third, it shifts control. Once stablecoin issuers plug directly into the central bank's orbit, they no longer compete with the state, they report to it. And that connection quietly builds the foundation for the next phase, the digital pound. At first, this is just regulation, but look closer, every structural element mirrors what a future central bank digital currency would need. Holding limits, real-time redemption, fully backed reserves, direct oversight by the Bank of England. It's the same architecture, just privately issued for now. In practice, the UK is building a two-layer system. Private stablecoins act as the pilot network, and the digital pound can slide into place when the policy decision arrives. So who's the winners and losers? The winners, large compliant firms, global payment providers and fintechs with deep pockets. They already have audit teams, risk departments, and the scale to play by the bank's rules. This framework opens the door for them to issue regulated sterling stablecoins integrated with banks and retailers. The losers? Small crypto projects and decentralized issuers that can't meet the capital or audit demands. They'll either partner with big institutions or disappear. This isn't decentralized finance, it's regulated finance wearing a digital badge. For everyday holders, these rules sound reassuring. Less risk, fewer collapses, more trust. But there's another side: privacy and control. Under this system, all systematic issuers will maintain detailed transaction records accessible to regulators. If stablecoins become the default way to move digital money, those records could effectively replace the anonymity of cash. Nothing illegal about that, but it changes the relationship between citizens and money forever. While the UK codifies its framework, the EU is still finalising how stablecoins fit inside MiCA, its broad crypto regulation. The US Congress remains divided. The Federal Reserve hasn't even chosen whether to pursue a digital dollar. And China's ECNY is already live in dozens of cities. So by acting now, Britain positions itself between the US's hesitation and China's execution. That's strategic. It means London could become the regulatory hub for compliant stablecoins, serving both traditional finance and crypto markets. The consultation is open until the 10th of February 2026. After that, responses will shape secondary legislation under the Financial Services and Markets Act 2023. If all goes smoothly, draft rules could appear later in 2026. In parallel, the Bank of England continues testing prototypes for the digital pound itself. No decision yet, but the technical groundwork is shared. So the sequence is clear: stablecoin regulation first, digital currency later. Today's document isn't the end game, it's the launchpad. Here's the hidden shift. What's most striking is how this changes the idea of money's issuer. For 3 centuries, commercial banks created most of our money through lending. With stablecoins, that creation process moves to whoever holds the reserves, still under the Bank of England's eye, but no longer tied to credit creation. That subtlety rewrites UK's financial DNA. And once money creation detaches from lending, policymakers gain a new lever. They can influence not only interest rates, but the form of money itself, how fast it circulates, who can hold it, and under what conditions. That's the quiet revolution inside this rulebook. Buried deep in the consultation is the reference to programmability features. Officials say they're not part of this framework, but they will be explored in future phases. That's a placeholder for the next debate. Should money carry built-in code that enforces how it's used? For now, the answer is no, but the technology is there, waiting. Every regulation is a trade-off. The Bank of England's priority is financial stability. That means limiting risk, even if it limits anonymity. The challenge will be ensuring that digital innovation doesn't erode basic freedoms, privacy, choice, and the ability to transact without constant oversight. These principles rarely vanish overnight. They fade through layers of compliance until we stop noticing they're gone. That's why this conversation matters now, while the rules are still being written. The UK stablecoin rulebook isn't an attack on crypto, it's an attempt to domesticate it, to bring digital assets into the same pen as traditional money. Whether that's progress or control depends on how those powers are used in the years ahead. For the public, it means safer assets. For innovators, it means higher hurdles. For policymakers, it means leverage. Every generation rewrites the rules of money. This time it's happening in real time, and most people won't notice until it's done. If you've made it this far, you understand why awareness matters. Because power doesn't always arrive with noise. Sometimes it arrives as regulation written in fine print. If this breakdown helps you understand what's really going on, take a second to like this video. It tells the algorithm that independent voices still matter. And if you don't want to rely on the headlines to know what's coming next, subscribe, because we dig deeper than the surface and talk about what's really shaping the world of crypto and finance. This isn't about hype, it's about awareness, control, and freedom. And the decisions being made now will define all 3. Thank you so much for watching. I'll see you on the next one.